All right. So what I just talked about was from the context of buyout. Now in the context of venture capital transactions. In venture capital, how is venture capital different from buyout, Mubin? VC different from buyout. How? Exactly. So in a VC, we are investing in startups. Now, do you think valuation mindset will be different? How? Sharik. Actually, if I say that debt is hardly used in VC investments, does that make sense? There is so much uncertainty that you say, I want to borrow some money from you and put it in a startup. Anybody will lend you money? No, there is so much uncertainty about what will happen that in general in VC investments, debt is not used. In that long laundry list that I showed you of the differences, one of those items was there. But could you guess that anyway? That in a VC, debt would not be used. Okay, so that's why you just read that laundry list once and then everything should just be logical. Okay, so the question that we are approaching here is the following. Let's say you are a VC firm and you are investing in a startup. Okay, and you are investing 1 million. How do you figure out what percentage of that company now belongs to you? Is that an important thing to figure out? It's very important, right? Because after 4 years, when you sell the company, then you don't want to be arguing about who owns what percentage. So there needs to be a mechanism of figuring out that if the VC has contributed 1 million, what percentage of the company belongs to him. Okay, so clearly that's an important thing to do. We'll touch on it now, and then there is a whole case study on doing this, which we'll do in the next segment. Okay, this is really straightforward. Logically, to figure out what percentage belongs to you, the VC, do you need to know how much the company is worth before the investment? Right, so let's give that value a name, and we will creatively give it the name pre. Why? Because it is pre-funding. So if a company is worth, pre-funding, we figure out that the company is worth 1.5 million. And how will we figure this out? Using the various private company valuation techniques that we've talked about, we'll figure out what's reasonable. But obviously, before the funding, we need to know how much the company is worth. Then let's say that the investment made by the private equity company is 1 million. So then does it take a genius to figure out that the post-funding value will be 2.5 million? Okay, so there is not much to it. The post-funding amount is simply the pre-funding amount plus investment. Okay, so straightforward concept, but in the middle of a long case study, it might be hard to pull this out. The idea is fairly straightforward. Okay, in this particular case, what is the percentage ownership of the private equity company? 40%. So it is simply 1 divided by the total value. So what I've just done is this is example 1 in your curriculum. So we've just worked through that. Okay, fairly straightforward. This is built in the appendix of this reading, the case study that we'll get to in the next segment. Okay, now from a private equity perspective, as I mentioned in my introductory slide, one of the biggest objectives is, okay, I want to get in for a finite time and then get out. So there needs to be an exit strategy. What does exit strategy mean? So how do I get out of my investment? Obviously, with money sitting in the private equity fund or sitting in a firm, that's not making me money. It's when I sell that. So when the private equity company invests in a given company, it's when it sells this company, that's the exit. Because when it sells the company, that's when the money comes back to the private equity investors. Okay, now what are the different ways of getting your money back? The most lucrative and generally the most preferred method is an initial public offering. So you start with a small company, make it large enough, and then you have a huge public offering. Okay, typically this gives the highest value relative to the other methods. Okay, generally high liquidity, you get access to capital. So in in an IPO, company shares are sold, the company gets lots of money, and the company can then expand further. The private equity firm that had maybe 40% shares can sell off those shares to the public at a high price. When does this happen? When is there a successful IPO? If this company is now at a stage where it has strong growth prospects, it has shown a decent operating history, it has decent size, so timing when to do this is important. A very simple case study. So I worked for a company called Mindtree. The company started in 1999, so I was lucky enough to join roughly there. So the company was funded by VCs, so some India-based VCs and some California-based VCs. So this company went, so I don't remember the exact dates, but roughly operated for 4 to 5 years, built revenue of over 100 million. And then in about 2003 or 2004, once the company had a solid customer base, a good record, this is where the company went public. And the company went public, the valuation was done based on a multiples approach. So the investors included the initial founders of the company, included VC companies. So when the IPO happened in 2004, obviously the VCs got a huge return on their investments, and the founders of the company also did very well because they put in some of their own money, but they also had a share in the company. So this IPO happened because of the successful record that was built over these years. Now the timing of this was, just as a side remark, the timing was very important. The company wanted to go public earlier. But do you think it makes sense to go earlier if generally the stock market is down and the excitement about IPOs is low? It doesn't make sense. So the company waited for the right time. Okay, another point that's not mentioned in the curriculum, but from my experience, I think it was very useful. Another issue was the location of the IPO. Okay, so for this particular company, the question was whether to go public in America or India. Okay, and it turned out that at this time, given that some of the senior management was Indian, they were much better known in India. So the decision was made that based on the higher level of recognition of this company in India and the higher valuations that were being received in the Indian stock market at the time, it made sense for the company to go public in India. Okay, so anyway, so these are considerations with an IPO, and this is the most successful exit because the initial investors get the most return. Okay, another is a secondary market where the company doesn't go public, but let's say another set of investors, be they financial investors. So another possibility might have been that Mindtree, being a technology company, rather than going public, a much bigger technology company could have bought this. Okay, would that have been, so how would the owners and the initial investors have benefited? So if the initial investors put in 5 million, this other larger company might just buy this for 10 million. That would still be a return, but typically when someone else buys, then the return is not as high as a IPO, but it's still an exit. Another possibility could have been a management buyout, which means that rather than selling shares to the public or selling shares to another investor, the management could have gone to the founders and said, look, we will buy your shares off you. Okay, so that happens quite a bit. It happens quite a lot in Pakistan, where management feels that they are the ones who've been working hard building the company, and yet they are only paid a salary. So management says, why not we go to the owners who are just sitting there doing nothing, making money. So we pay off the owners, and then the profits that we make in the future belong to us. Okay. I'm not, yeah, I would not be surprised. I know of other examples. I'm not aware of the Engro example, but it happens quite a bit. Okay. Some of you might do this in the future, right? Because if you are working at a company and you are confident in your own abilities to run the company, then you can borrow money, buy out the company, and use the cash flows to pay off, and then you own the company. Okay. And then what's the worst thing to do? The worst or the most unfortunate is where the company doesn't go as planned. So then you simply sell off the assets, liquidate. So typically there are losses over here. Okay, now understanding the structure, we've talked about this briefly. We've already talked about what's the difference between a general partner and a limited partner. So general partner is the main entity who is running the private equity firm. So then you have limited partners who are investing money. Okay, so what is the core function of the private equity firm? One is to raise funds, and the second is to invest those funds in companies. Okay, now the way this works is when the general partner raises funds, the general partner receives commitments from a limited partner. So the general partner might say that I want to raise 10 million. Does this mean that all the limited partners immediately dish up 10 million? It doesn't happen that way. What happens is there is this drawdown period or investment period. So the typical lifespan of the fund is about 10 years. The first 5 to 6 years, the company, let's say it receives commitments worth 10 million. Those $10 million are received over a period of time. So as the private equity firm, the general partners identify companies to invest in, they then draw down. Do you understand the term drawdown? So if a commitment of 10 million is made, then in the first year, out of those 10 million, for example, the private equity firm might raise 3 million. So that's drawing down 3 out of the 10 million. In the next year, the private equity firm might draw down another 2 million. So idea being over a 5 to 6 year period, you draw down this entire 10 million. What's happening with that money? That money is being invested in companies. The companies are being then improved, and then after a few years the company is sold, and what happens with the sales proceeds? Then they are returned back to the investors. Okay, so that's the general idea. Okay, so what are some core terms from a testability perspective? What is it that you need to know? Okay, and again there is a lot written here. I'm just going to focus on the core points. Management fees. Who do you think gets the management fees? The general partner gets the management fees. And what do you think those fees are based on? Yeah, so there'll be a combination. Typically when we say management fees often are not based on performance. That is something else that comes later. Management fees represent a percentage of the committed capital paid annually to the GP during the lifetime of the fund, and this would be typically about 2%. What is the committed capital? Yeah, so in my earlier example, it's the 10 million. Does it mean that immediately is the money that is raised or invested? No, that just means the commitments made by various providers of funds. So the most common management fee structure is that the GP gets 2% of the committed capital for the life of the fund. There are other scenarios, but not as important. So another way the GP makes money is through transaction fees. So if the GP provides some advisory services, some investment banking services or any other kind of fee-based service, that's another way of making money for the GP, and that's called transaction fees. Some of those fees might be split with the LPs. Okay, now here is from a testability perspective, here is an important term called carried interest. So carried interest represents the general partner's share of profits generated by a private equity fund. Carried interest is frequently in the region of 20% of a fund's profits. So if a GP does really well and the profits of a given fund are 100 million, okay, do you think the GP who's done all the investment and helped improve the company, will he claim some of this profit? Yeah, so the claim of this from this profit for the GP is called carried interest. Okay, so that's the carried interest. Okay, it is often about 20% of the fund's profits. Okay, I will skip this ratchet term because I don't think it's overly important, but you can read it. I'm just focusing on the most important terms. Okay, this should also sound, what is a hurdle rate? Yeah, you saw this roughly in IRR. If you are all LPs, okay, do you think it is reasonable for you as a limited partner to say to me, the general partner, that I can only get my carried interest if the return is over a certain percentage? Okay, so we might agree that the hurdle rate is equal to 8%. That means that only if the IRR or the return on the projects is greater than 8% do I, the GP, get my carried interest. Okay, so does that make sense? So a hurdle rate must be exceeded by the GP for the GP to get a share of the profit. Does this mean that if the hurdle rate is not exceeded, I, the GP, don't get my management fee? No, the management fee is fixed, that's roughly 2% of committed capital, but the carried interest, which is sort of my incentive compensation, that depends on my exceeding a hurdle rate. Okay, target fund size, this is just a general point. I might say that my target fund size is 10 million. That means how much money am I planning to raise? Vintage year is the year in which the fund was started. And term of the fund is roughly how long I want the fund to continue. Okay, now read this. Okay, so I hope this makes sense. I'll just highlight the main points. What does committed capital of 100 million mean? So this is how much the investors have committed. Carried interest of 20%. What does this mean? So exactly. So 20% of the profit will go to the GP. But will this always go to the GP? It will only go if the hurdle rate, if the return of 8% has been exceeded. The fund called 75% of its commitments from investors. What does this mean? Yeah, 75%, which is 75 million, has been called, which means raised, which means 25 million is still due at the beginning of year one, which was invested in target company A for 40 million and target company B for 35 million. Suppose at the end of year two, a profit of 5%, 5 million has been realized by the GP upon exit of the investment in company A. Okay, so in company A, at the end of 2 years, we went from 40 to how much? 45 in 2 years. Okay, what's the IRR here? 2 years. IRR is an annualized number. What sort of a return has the GP given? Exactly, the return is 6.1%. So this is over 2 years, so you should get 6.1%. So will there be any carried interest here? There will be no carried interest because the GP did not exceed the hurdle rate. Okay. So suppose also that the GP is entitled to a carried interest on a deal by deal basis. I'm going to explain this later. But the point here is that even though a profit was made, the GP doesn't get anything because the hurdle rate was not exceeded. Okay. Now a few more. So what I talked about was economic terms. Now some corporate governance terms. A key man clause. A key man clause. So under the key man clause, is it logical that when a VC fund or for any private equity fund invests in a company, there should be some constraints that the key people in that company just go somewhere else? There should be such a clause. That's a key man clause. And if somebody does go somewhere else, then what happens is defined in this clause. So for example, this clause provides that a GP may be prohibited from making any new investments until a new executive is appointed. Okay. Others, this is obvious. A clawback provision. Any guess as to what this might mean? What does clawback mean? Clawback means you claw in and take money back. So this context is between a LP and a GP. Between LP, so GP is managing, LP is providing funds, GP might also be providing funds. What do you think the incentive of a GP would be? Okay, so broadly speaking, there are two ways in which a GP can structure an arrangement with LP. Is the GP, if a GP is getting, say, 100 million, is the GP putting all 100 million in one deal, or is he using this 100 million to invest in several deals? Several deals. So the one question about things like carried interest and so on, do we calculate the carried interest at the end of 10 years once we know overall what's happened across all deals, or do we go on a deal by deal basis? So they are both possibilities. What would a LP prefer? No, LP would actually prefer look at it at the end. A GP would prefer deal by deal basis. So for every deal I make money, I get my carried interest. A clawback provision says that in a deal by deal basis, if the GP, let's say, makes a lot of money in the first 3 deals and exceeds the hurdle rate, will the GP make carried interest? He will. But then in the subsequent deals, what if those deals flop and the GP loses? Then what happens? Then if there is a clawback provision that allows the LPs to claw back and take some of the profit back. Okay, let us go through one more context, some examples, and that will be the end of this segment. Okay. When we talk, what I'm talking about here is something called a distribution waterfall. A distribution waterfall is a mechanism providing an order of distribution to LPs before the GP receives carried interest. What does this mean? You can have an arrangement called a deal by deal waterfall. What do you think this means? A deal by deal, this is what I was alluding to earlier. This is where, let's say 100 million is invested over 5 different deals. The GP gets carried interest based on every deal. So if on the first deal the GP makes a 20% return, he's exceeded the hurdle rate, on that first deal the GP will get his carried interest. Then on the second deal, again, you look at every single deal on its own, and you then figure out how much carried interest based on a deal by deal basis. Good for the GP. Okay, the other scenario is a total returns waterfall where you take a more holistic view. So in this there are 2 alternatives. In alternative 1, the GP gets carried interest only after committed capital has been returned. So let's say the total committed capital is 100 million. This is, let's say, how much the LPs or the providers of funds are giving. So in this case, the GP gets carried interest only after this 100 million has been returned, and then if the hurdle rate is 8%, only if the amount returned exceeds 108 will the GP get any carried interest. As an LP, do you like this? Yeah, as an LP, you like this because you are saying, okay, do the whole, work through this whole fund, and in the end, based on how you've done, that's when you get your incentive. Okay, whereas what will the GP prefer? That deal by deal, the GP would like to keep getting his money. This is one option where we go based on committed capital. The other alternative is based on invested capital. What's the difference between invested capital and committed capital? Yeah, invested capital means just because the committed amount is 100 million, let's say in the first 4 years, the amount invested is only 60 million. Is this possible? Yeah, so in this approach too, we look at how much is returned relative to the invested capital. This also makes sense because as a LP, that's what you've put in. Okay, now read this. This is example 3. And this is the last thing that we'll do in this segment. So do it well. Okay, so let's do this together now. Hopefully you've gone through this. Okay, suppose a private equity fund has a committed capital totaling 300 million. So the committed capital is 300 million and a carried interest of 20%. So Atiq, what does carried interest mean? Saad, carried interest. Exactly. So it's the percentage of the profit that goes to the general partner for all his hard work. Okay, just making sure you are with me. Okay, after a first investment of 30 million, the fund exits the investment 9 months later with a 15 million profit. So the first investment went from 30 to 45 in only 9 months. Is this good? This looks pretty good. So what will the GP want here? Okay, he would want some return based on his fine performance in the first 9 months. So under the deal by deal method, the GP would be entitled to a 20% of the profit, i.e. 3 million. So what happens in the deal by deal method? Has he beat the, have they talked about a hurdle rate here? Whatever the hurdle rate, this looks like a pretty, this would exceed any, hurdle rate in the 8 to 10% range. So the GP would get his profit under the deal by deal approach. Okay, now what about in the total return method? Remember, there were two flavors of the total return method. One flavor was based on the entire committed capital and the other flavor was based on the invested capital. So which one was the first alternative? That was based on committed capital. In the first alternative of the total return method, would the GP get anything? The GP would not get anything because that is based on getting a return above, as in once the LPs have gotten back their 300 million and profit beyond that, only then would the question of carried interest come up. Okay, so here there will be no, under this flavor 1 of the total return method, there is going to be no carried interest. Okay, what about in this? Yeah, exactly. Yeah. So the whole point, and you can see typically this method is not used much because in the total return method flavor where we are looking at the entire contributed capital, the general partner will only get carried interest if the LPs get back, let's say, 340 million or more. So we have to, obviously the prerequisite here is that the entire contributed capital is indeed drawn down, and then the investors get all their money back plus a substantial profit. Okay, so a GP would only agree to this if he is sure about being able to draw down the entire amount. The more realistic one is this invested capital based, where you calculate based on the total amount invested to date. So in the second alternative, the exit value of 45 million exceeds by more than 20% the invested value of 30 million. Okay, so here, even though it's the total return method, but if we are considering the invested capital, then the return of 45 million is well above the invested amount of 30 million. So the GP would be entitled to his 20% profit of 3 million. Okay, now remember the clawback I talked about. So continuing with the above example, with the clawback provision, what was the clawback provision, Sana? Who's you? Yeah, exactly. So clawback means that in subsequent deals, if there is a loss, then the LP effectively can claw back some of the 3 million that he has given as carried interest to the GP. Okay, so suppose that the deal by deal method applies and that a second investment of 25 million is concluded with a loss of 5 million 1 year later. Therefore, this annual true up means that you do a reconciliation every year. Okay, the GP would have to pay back 1 million to the LPs. So because of the reconciliation, where does this 1 million come from? So the point here is how much profit was made earlier? We went to 15. So the profit here was 15 million. Now there is a loss of 5 million. So overall, how much has the profit been? 10 million. So overall, up till now, the GP has earned 20% of 10 million, which is 2 million. In a deal by deal scenario, how much has the GP already claimed? 3 million, but he should have only claimed 2 million. So if you do an annual reconciliation, what happens to the 1 million? That's clawed back by the LP, so the LP takes back 1 million. Now realistically, or in practice, an escrow account is used to regulate these fluctuations until the termination of the fund. So in this context, an escrow account is a separate account where any flows of this clawback are put in the escrow account, and at the end of the life of this fund, that's when the settlement actually happens.